Such a perfect day to have you on. Looking at the 5-year now at its highest level, the yield since February of 2020. Are you preparing your clients and portfolios for a possible rate shock to come?
Well, what we think, I think it's important to note is the 5-year is really the underperformer, right? So 5s, 10s is flattening and 2s, 5s is steepening, which suggests that market participants are concerned about the next few years. We have talked about higher inflation. It's obviously in our minds a result of two things. One has been obviously the restart of the economy following COVID, and obviously the supply chain issues that we've had that have exacerbated higher prices, particularly the energy market. Listen, we're calling for yields to continue to rise here in treasuries, but believe that the Fed rate path, the hiking path, will be relatively shallow, all things considered. Again, noting that in our mind, this is a supply shock that is driving inflation higher. It may be with us for some time into 2022, but we believe that it will slowly ease as this year turns to next.
Scott, good morning to you. So if you think it's transitory, perhaps even persistently transitory, what does that mean the market has got wrong? The U.S. yield is pricing in 2 rate hikes in 2022. Is that too much, or is that the market hurrying the Fed along?
Well, I think there's an interesting dynamic going here, right? Obviously, this is a very unusual environment that we're in, right? So the restart, the COVID crisis are all things that policymakers have not had to deal with in the past. And so the market is trying to figure out whether policymakers will lean against the inflation that we're seeing, whether they believe, as we just heard the Bank of England governor talk, whether it's transitory or not. Our view is that currently there is too much rate hikes priced in for 2022. We believe that the rate path will be shallower than the current market pricing. But clearly, right, there is a very active debate here, given the high levels of near-term inflation that we're seeing. But right. To answer the question directly, we see less in 2022 than the market is pricing.
Well, certainly part of that active debate, Scott, is what's happening with the U.S. consumer. Bloomberg Economics looking at a study seeing that there are trillions of dollars of savings that the U.S. consumer is not yet spending. Some of these sentiment readings coming in weaker on Friday as well. What do you make of the U.S. consumer?
Well, this is a really important point. So one of the big differences between now and the 1970s, why we think the stagflation analogy or comparison is incorrect, is that the economy still has room to grow in the U.S. To your point exactly, is that, we believe that there is, more room to grow in the economy. The economy will continue to expand. And so we have, a supply shock in energy, but we believe demand will rise to meet that. Supply will rise to meet that demand. And so we're more positive on the economy going forward. And for us, that's a very important point and underpins our view around equities, but also underpins our view about why this isn't the stagflation scenario that we saw in the 70s.
Let's just extrapolate that along then. So it's not the 1970s. Sure. Inflation will roll over. So a lot of people have come on the show, Scott, and they said, oh, we don't want to be long duration. We want to shorten that portfolio exposure. I had a guest yesterday who wants to run against that trend because of the narrative of peaking in inflation. He wants to extend and take duration. He wants to take a Ramco risk. He wants to take Qatar Petroleum risk at 50 and 70-year bonds. Where are you on duration?
Yeah, so we are short of duration. We are recommending that clients are shorter than benchmarks or have less interest rate exposure. So we would take the opposite view. So the view is that the rate path, the monetary policy rate path, will be shallower, but we continue to see bond yields rising over time, in part because we believe they're at the wrong level to begin with, given the level of economic activity that we've seen. So there continues to be an adjustment higher in interest rates, albeit not as violent as we've seen, obviously, in the last 2 weeks. But again, we continue to believe interest rates will rise over time.